have Taimur Baig, who's MD and Chief Economist at DBS Bank, to help us understand the impact of the global risk-off, which has just turned, accelerated in the last couple of days on financial markets. Taimur, morning. Thank you very much for your time. Let's start with China. A lot of bad news coming in over there. Now, again, very large realty players like Evergrande, all of that, have filing for bankruptcy. Just a few days back, they had kind of released a little more stimulus into the system, giving a sense to the world that things are really very dire in China. Let's start with that. How do you gauge the bad news coming out of China?
I think there's no sugarcoating the narrative out of China. The mountain of debt around the property sector is substantial, and it is having a major impact on investment sentiment, on consumer sentiment. If you're on the buying side of the property as a consumer, you were worried that the value of the property may not be holding up, or you may not even get delivery of the apartment that you're waiting for. And if you're in the building side of the equation as a builder, you are probably worried about the debt that you've taken to build, whether you can service it or not, whether the next time you refinance, how much interest you would get from your creditors. So it's a bit of a spiral, if you will. Both the buying sentiment as well as the building sentiment is very poor. Normally, these things do not necessarily get ameliorated by 25 basis points of rate cut. You need much more than that, a major proactive debt restructuring with full participation of the private sector. One thing I'd like to hasten, and this is a truism that holds across geography, is that when you have a large bad debt situation in the property sector, whether it is the Japan story from the 90s and 10s and the US story in the teens of this century, you need strong involvement of the private sector, debt restructuring funds, so-called voucher funds, and so on. So China would need global investors to get excited about the debt restructuring story there. There is sufficient capital in Hong Kong, in the US, in Europe, and within China as well. If they want to get the private sector involved, where bad assets are restructured, repackaged, given in the hands of those who are professionally very successful, they have a track record of successful restructuring, I think the economy can turn around. It happened in the case of Japan. There's no reason it can't happen for China. There are political considerations, there are geopolitical issues. That, I think, is coloring the matter substantially. And I would like to also end this point by saying that global investors are not completely shying away from China. I think that's a narrative that needs to be corrected, because I think we have seen a few too many articles in recent days saying US firms are scaling back on China. Well, US is not the only source of capital as far as China is concerned. As I said earlier, you've got quite a bit of capital sitting in Hong Kong. Sovereign wealth funds in the Middle East have shown quite a bit of interest in China. And therefore, when we look at monthly capital flow data, July was actually a pretty good month for China. It was not a very good month for Chinese markets, but as far as inflows, FII inflows are concerned, they were pretty decent.
Right, that's quite interesting. But would you say, Taimur, that that's largely a play on valuations looking quite ripe for China right now? Because, there's nothing that seems to be indicating that China is out of the woods.
Right. You can always say valuation gets cheaper if the macro story doesn't turn around. So, no, I think that one could have made some compelling arguments for Chinese equities being good value maybe 6 months ago. And they've gotten actually cheaper since then. And that's where I suppose the policy imperative comes in. Going strictly by valuation perspective, there should be a lot of interest in China. But clearly, it is not the only valuation dynamic that is involved here. The inclination of the authorities to allow the private sector to find the right price, allow them to have some unfettered movement of capital, both in terms of purchase as well as liquidation of assets. That's where I think the market uncertainty is still substantial. Until that is taken care of, it can be cheap. It still may not be attractive.
Taimur, hi, morning. Wanted to also get in your take on, things back home. The state of the economy as flagged off by the RBI in their bulletin. And, they're clearly talking about how now there's a less possibility of oil prices easing, and that the shadow of El Nino looms, and the fact that the genie of inflation is still out of the bottle. Headline inflation still above 6% for Q2.
I have limited worry about this matter. And some worry, of course, I get paid to worry. So some worry, but not a lot of worry. Even last year, when we had tremendous amount of anxiety about food and energy security worldwide when the conflict in Ukraine broke out, we eventually saw heroic supply side response, heroic response in terms of transportation solutions to take excess wheat or oil or gas from around the world and take it to the places where there was a demand-related uncertainties. And therefore, I don't think that issues related to El Nino or OPEC cuts or lingering tension in Ukraine would be the spoiler for inflation again. It would probably stop inflation from coming down the way we were hoping. It may force central banks to maintain that so-called higher for longer narrative, but it would not lead to another round of rate hikes. Absolutely not. I think the amount of monetary tightening we have seen around the world, it will be felt for months, if not years to come, in terms of higher cost of funding, in terms of difficulties of maintaining margins. So I think there's been sufficient tightening worldwide, including India. So RBI signal, which is they need to be careful about inflation, absolutely valid. But at the same time, I would not necessarily read that as saying we're going to be hiking rates substantially. It's more like we'll keep rates where they are, don't expect rate cuts. I think that's what we need to take away.
Appreciate your time, Taimur. Thanks so much for joining in and giving us a view on macros globally as well as back home.